For months, Wall Street soared with the S&P 500 and Nasdaq smashing records on a wave of tech optimism and investor cash. But as we approach the end of 2025, the mood has shifted from euphoria to anxiety. The market feels fragile, like a Jenga tower missing too many blocks. Volatility is up, tech giants are slowing, and talk of a correction is growing louder. The rally made many feel invincible, but seasoned investors know no party lasts forever. Now, doubts are creeping in. Do the fundamentals really justify these sky-high prices? Corporate earnings are solid, but not spectacular. Economic growth is steady, not explosive. The disconnect between market euphoria and economic reality is making investors nervous. It feels like we're running on fumes with no gas station in sight. For a long time, greed was in control. Everyone wanted in, afraid to miss out. Now fear is taking the wheel. Investors are eyeing their portfolios, wondering if it's time to cash out before the music stops. This shift in sentiment is subtle but powerful. The market is a reflection of collective emotion, swinging between fear and greed. That's why the air on Wall Street suddenly feels so heavy with uncertainty. The party isn't over yet, but the hangover may be coming. When Fed Chair Powell speaks, Wall Street listens, and his recent warning about elevated stock prices sent a chill through the markets. In central banker speak, that's a major red flag. Powell's concern isn't just academic, it's a signal that the institution responsible for financial stability is worried about a potential correction, or worse. The core issue, a massive gap between stock prices and their underlying value, especially in tech. Powell's warning is a reminder that gravity always returns. The fear is that when the correction comes, it won't be gentle. Are we in a bubble? The ingredients are all here: new tech hype, easy money, and the belief that this time is different. History says such moments rarely end well. Powell isn't predicting a crash, but he's tapping the brakes, hoping the market listens before it's too late. Investors now face a tough question. Is this the top? The risks are rising, and the fire chief just told us the house is a tinderbox. What's keeping stock prices so high? Two things: AI hype and a flood of foreign money. The AI boom has sent billions into any company with .ai in its name, fueling a tech rally driven by FOMO. Meanwhile, foreign investors see the US as a safe haven, pouring cash into stocks and bonds. This powerful combo has pushed markets to dizzying heights, even as warning signs flash. But here's the danger: retail investors are running on empty. Cash reserves are at historic lows. Most people are fully invested with no cushion. If the market drops, there's no dry powder to buy the dip, only panic selling. A small decline could trigger a cascade, as nervous investors rush to sell, turning a correction into a crash. The market has lost its shock absorbers. Big institutions and foreign buyers may keep things afloat for now, but the average investor is exposed. If fear takes hold, the sell-off could be fast and brutal. The AI hype and foreign capital have built a house of cards. Without cash on the sidelines, any bump could bring it down. The risk of a rapid, violent decline is real. The market's resilience is being tested, and it may not hold. Investors face a double whammy: a weakening dollar and a Federal Reserve caught in a policy bind. A softer dollar helps U.S. exporters but fuels inflation by making imports more expensive. The Fed is torn: cut rates to support growth or hold steady to fight inflation. This uncertainty is rattling markets, as no one knows which path the Fed will choose. Every new data point or Fed comment sparks volatility. On top of that, the threat of new tariffs looms, adding more risk to trade and inflation. Tariffs disrupt supply chains and raise costs for consumers. For investors, it's a toxic mix: a wobbly dollar, a confused Fed, and the specter of a trade war. Markets hate uncertainty, and right now, there's plenty of it. The result? More volatility, less confidence. The party on Wall Street is looking shakier by the day. One of the biggest red flags: stocks and bonds are telling completely different stories. Stocks are soaring, driven by tech mania and speculation. But the bond market, often called the smart money, is flashing warning signs, with volatile yields and inconsistent demand. It's like one neighbor sunbathing while the other boards up for a hurricane. The rally is narrow, led by a handful of tech giants, while other sectors lag. A healthy market lifts all boats. This one is just a few speedboats racing ahead. If optimism fades, say from bad earnings or a Fed surprise, there's little to cushion the fall. With bonds not providing stability and cash reserves depleted, a sell-off could snowball. The current highs feel more like the top of a roller coaster than a sustainable peak. Smart investors are already checking their safety harnesses. The risk of a sharp correction is real and rising. While US markets worry, Europe faces a deeper crisis. The Russia-Ukraine war shattered Europe's energy model, sending costs soaring and squeezing industry. Germany, once Europe's growth engine, is sputtering as factories struggle with high energy prices. The EU is scrambling for new energy sources, a costly, years-long transition. On top of that, US trade policy is treating allies like rivals, with tariffs threatening key European exports. European industries, especially autos and luxury goods, face massive uncertainty. The continent is squeezed from both east and west, war and energy loss on one side, US protectionism on the other. The result: slower growth, persistent inflation, and a broken economic model. Europe's old prosperity is gone, replaced by painful adjustment. The double bind is damaging Europe's trade balance and industrial health. The continent is searching for a way out. The threat of renewed US tariffs is making Europe nervous. Trump's trade strategy, tariffs on allies as well as rivals, created friction and uncertainty. European industries, especially autos, were left guessing about their future in the US market. Even the threat of tariffs acted as a brake on investment and growth. With Trump possibly returning, Europe fears another round of economic pressure. The message is clear: relying on the US market is a vulnerability. Europe is being pushed to rethink its global strategy and diversify. The tariff playbook isn't just hurting allies, it's driving them away. Europe is looking for new partners and new markets. Facing stagnation at home and an unreliable US partner, Europe is pivoting east, to the BRICS plus nations. These emerging economies offer new markets, cheaper manufacturing, and crucial energy resources. A key example: the EU's growing partnership with Indonesia, a gateway to the wider BRICS network. By working with Jakarta, Europe can access China and Russia's markets and resources, sidestepping political baggage. High energy costs and strict regulations make it hard for Europe to compete. Shifting production east helps regain an edge. The IMF predicts BRICS will account for over half of global GDP by 2030. Europe's pivot is a pragmatic response to a changing world order. The old US-led system is fading. A multipolar world is emerging. Europe is forging new alliances out of necessity, not choice. The future lies in the east, and Europe is moving fast to secure its place. It's a hard pivot, but a necessary one.